Coming back out of the holiday, some folks understand that this is a seasonably strange time for the markets. There is some weakness coming back from the Labor Day weekend at times. But in your mind, is the rally going to stay intact for the final 4 months of the year?
So I'm going to say I'm cautiously optimistic because there are a lot of good things going on. And I think when you look at what we've seen from payrolls and other places, we're getting kind of the best you could expect in terms of, some softening in labor markets, but not too soft. People coming back into the labor pool, all those kind of things are good. The hard part is a lot of that good news is priced in. So you're up close to 19% total return for the year. So I do think you have to be a little more cautious on the margin here, even though, again, I give you, there's been a lot of good news. I think you have to push worries about recession out until at least next year now.
If the recessionary picture, though, is something that's in question, we have some data out suggesting a potentially rough month for stocks ahead. We've got S3 Partners revealing bets against the U.S. stock market reaching $989 billion last week. That's up from $886 billion at the end of last year. Meanwhile, you've got data from Refinitiv showing money put into the U.S. funds has been dipping over the past 5 or so weeks. That's the longest losing streak since the regional banking crisis back in March. And then you've got bearish sentiment on stocks hovering at 34.5% for the second straight week. That's above the 11-week average, with bullish sentiment now below its historical average. So you have all of this sentiment, economic data coming together. You say you're cautiously optimistic, but aren't there signs now that we could see a lot more volatility ahead?
Yeah, I mean, I think it goes with the territory, right? When a lot of things have broken the right way, and when stocks are up a lot, you're generally, I think, more apt to see some disappointments occasionally. So that's why, again, I tilted towards being a little more defensive with new cash, even within stocks. Because, again, the other part going on underneath the surface in stocks is the extremely, or not, I shouldn't say extremely, the more cyclical components, the economically sensitive components have done really well, and rightly so, because earnings have probably bottomed. You have to push we're all worried about recession, you have to push that out, I think, till next year. So I think it's all that's right. It's just maybe at a bit of an extreme that you'd want to fade a little bit and look at these, more defensive sectors that have done, frankly, are down for the year so far.
Bill, the big concern for a lot of folks out there right now is the economic picture, the inflationary outlook, what's going to happen with the jobs market. You mentioned it's still relatively strong, the jobs market. Is that going to be enough to outweigh the uncertainty about inflation that still lingers, especially heading in to that key consumer holiday shopping season?
Well, like I said, right now we're threading the needle. Kind of since we're in football season, I almost say, the last jobs report was, close to throwing that Hail Mary in the sense that you got some softening, but then you also got more people coming back into the labor market, which that would be the best outcome for everyone, which would be more people come into the labor market. It softens up wages, but people have jobs. It doesn't lead to some sort of downturn in the economy. But again, that's a probably lower probability than what we typically see, which is eventually a slowdown. But again, right now, a lot of jobs, still jobs net being created. When jobs are created in the U.S., U.S. consumer tends to show up and spend. So I think there's less reason to worry about that, whether you want earnings downturn or so forth here, certainly in the short run or for the rest of the year.